good thing.
Yeah. Okay. And so, so that's the general concept of partnership. There's just different forms of partnership. Again, limited liability company, it means that all of the participants have limited liability. It's a little bit like a corporation with a pass-through feature. And it's particularly popular for real estate.
It is.
And that sort of, I think that's almost what it was designed for. And so there are special features related to that. We've talked about in other interviews that I've had. So we're not going to dwell on that right now. But you know, just be aware that there are different ways that you can, these things can be structured, and you may need to talk with a lawyer or a tax advisor about what it means for you. Mm-hmm. All right, so the next area of passive investment is private lending. So let's talk a little bit related to that.
So private lending is different than partnership because you're not going to really participate. You're simply lending your money to somebody who wants to purchase real estate. And oftentimes it's 1-to-1 ratio, meaning your money is helping to buy one piece of property. And maybe the person is going to go in and rehab that property, and they're going to pay you like you're a mortgage company so that they don't have to go through the long, tedious process of getting financing. The key on being a private lender is knowing what you're doing. Because if you go in and you're in a second position, meaning you're after the main mortgage, and there's not enough equity, you could lose all your money because they're going to have to sell it short. So you want to make sure that you're always in a first position if you're doing private lending, that you have an attorney and a CPA review everything that you're doing to make sure the paperwork's in order and that you know the tax consequences of what you're doing, because it all plays into whether you're going to be profitable as a private lender.
Right. So in other words, as a private lender, first of all, it means that you're going to be the bank.
Yes.
And so there's a few things related to that, obviously, and that is when you're lending your money to somebody, you want to, as we say, know who you're getting into bed with.
Yes.
And so you need to do a little research yourself, and might even want to buy information from a credit company or hire a private investigator or whatever. There are research services that are available, some of which are pretty reasonable and can be a worthwhile investment.
Typically for less than $40, you can find out credit history and background, whether you're dealing with somebody who has criminal convictions. So it's worthwhile to do that investigation. You also want to make sure that you have your paperwork in order. Don't assume that because they're giving you paperwork that it's the right paperwork. You want to have your own support team review that so that you're protected, that you know the usury laws. You know, they might say, oh, I'll give you a 30% interest. Well, you can't collect 30% interest. Mm-hmm. You know.
But you can get an equity participation.
You can. And equity means that you get to participate in the profit that is put into the property, or you get to participate in even some of the write-offs. If they're going to keep the property for a while, you might maybe need the write-offs against your income. So as an equity participant, you're being part owner in the property, and that offers you some various flexibility.
Okay, so look at it carefully, but this idea, again, that you see with most private lending, you're structured as a note. That means you know, or you should know, if you've got enough protection there, again, that there's enough equity on top that you're not lending against, that you should get your principal back at least, and then hopefully get some additional amount as well.
Most private lenders right now are lending in declining markets 50% of today's value to protect it. It used to be pretty common that in the increasing markets, the appreciating markets, we'd see 70 to 80%.
That's pretty
We
aggressive.
don't want to do that anymore.
Yeah.
If you're doing private lending, stay in the 50 to 70 range for protection of your principal.
Okay. So let's talk about note brokering and buying for a few minutes. That's sort of related to this area. But
so note buying is that you're buying somebody else's note. So let's just talk a bank. Let's say that Chase has a note on your house, and the note is worth $300,000. Well, they maybe want to cash it in. They want the cash to do some other things. So they'll sell your note to Wells Fargo. and they'll sell your note at a discount. Even though it's a $300,000 note, they might sell it for $150,000 just to get that cash so that they can go do something with the cash. Well, the person buying it gets the cash flow. Right. And it's good if you're looking for monthly cash flow. And so you just got $300,000 worth of a note for half price, and you're going to get the cash flow over the 30 years, which really turns out to be a lot more than the $300,000. When it's a fully amortized loan, it might be as much as $900,000 that you're getting for that $150,000.
Now, are you going to be buying these notes from banks, or are you going to be buying them from individuals?
Both. Both are available. There are note brokers out there that if you're interested in buying, they can help you locate a note that fits what your parameters are. And you can buy notes in your IRAs, your Roth, your 401k. You can use that money to buy them. And the cash flow then goes in and feeds, you know, and it grows. So you can buy either bank notes. They have two classes in bank notes, performing and non-performing. Or you can buy private notes, like a seller carryback. Somebody sold their house and they weren't able to get all the money they wanted, so they offered financing. You can buy those notes and earn usually higher interest rates on those. Now you might say, why would somebody want a non-performing note? For the opportunity to foreclose. So imagine a house is worth $450,000 and you buy a non-performing note for $150,000. You can't get the person to perform, you foreclose on the home, and now you have a lot of equity in that house.
I see. Okay. Let's move on to some more active types of real estate alternatives. So let's start with buy and flip, and I guess this is type of what we call a wholesaling type of an approach.
Yeah. So if you find a good deal and you buy it and you flip it to somebody else, we call that wholesaling. And you have to be careful in wholesaling because you might be considered a broker. We know that real estate agents need licenses, brokers need licenses, so you have to understand the laws and the legislation in this business. But when you do, wholesaling is actually the least risky real estate business to be in, because before you buy, you already have your buyer. So you're simply putting the deal together. You're negotiating what the seller wants and giving them what they want, which isn't always money. What they really want is peace of mind. And then you're selling it at a discount to somebody who's usually an investor who's going to rehab it and make their money on the end also. So you're kind of the matchmaker. Okay.
But this may be the deal. Again, we were saying wholesale, that you're finding somebody, again, they may be in a financial difficulty, whatever, or maybe, again, the estate or trust type of situation, a family wants to get rid of a property quickly because the relatives want their money.
Yes.
And so you've got a situation where you may be able to negotiate a better deal, and then, but you're not trying to get the top dollar or what you would sell it to a final buyer. You're selling it to an intermediary so that that person can deal with maybe the rehab or the other types of things that need to be done as far as the hard work type of stuff. So you sell it to them, that opportunity, and then they can take it from there and then ultimately sell it and hopefully make a profit themselves.
That's correct. That's correct. Yeah. Okay. So you're the deal finder and the deal matchmaker, and you make a little bit of money in between. You're not going to make a lot of money, but the people who are proficient at wholesaling can do 10 of them a month.
Okay. Now let's talk a little bit about fix and flip. So this is the...
Yes, fix and flip is it's in my DNA.
Okay.
I grew up with a mom and dad that would do this, and then shortly after college I started doing it on my own. Fix and flip is probably the most complicated real estate investing that you can do, but unfortunately it's where most beginners start. They walk into a house, they see all the potential, and they buy it, and then they hire a contractor, and they go off to work, and they assume everything's going to turn out well, and it's going to be ready to sell in 6 weeks. And when they come back and check on the contractor, he's taken their money, and nothing's been done on the house. And so you have cost overruns, you have time overruns, and in this declining market, you have to time your property quickly or you're going to lose the market, and what you had in there is equity. So what most beginners end up doing after a failed fix and flip is they turn it into a rental property, and it typically has negative